Welcome back, everybody, to the Investors Roundtable, the last Investors Roundtable of 2020. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K Kraft. That's BobbyKKRAFT. And today's episode is Hindsight is 2020, because guess what? That is actually, you can say that, and it is the truth. Hindsight is 2020. As you know, from an investing perspective, of course, this is the Investors Roundtable. So that's what we got going on today. Let me introduce you to our panelists. It's an OG crew today that I'm very excited to have. I know Kevin just learned the meaning of OG, so I think he thinks it's now a compliment. So we got Kevin Shea, the good prick, at the good prick, and I think we're what, like 13 followers away. We're almost there.
Encouraging.
You're surging. You're surging like some of these microcaps we've seen the last couple of days here. So let's get you up there.
Going viral, which is a theme for 2020. But
oh man, Gary, we got Gary Ribe, host of In the Market Trenches. Gary, what's going on?
Just living the dream.
Just living the dream. That's right. And then we got all the way. He doesn't have to have a fake background like the other three of us right now. He's actually in a very beautiful place. So we got Stephen Kiel set up remote from Miami, right?
Yeah, sorry. Let me learn how to do that mute button. But yeah, great to have you here. Great to be here on the last day of the year with everyone. I came into Miami last night. The weather's a little bit nicer than New York, so happy to be here and looking forward to talking about some stocks.
Yeah, no, it's great to have you on, and great to, and let me just start off and say thank you guys, you know, for being consistent and jumping on here whenever you're available, and you've added a lot of value to the show. So I definitely appreciate you. I know I should probably say that for the end, but I'll say it, I'll start off right now because we had a lot to cover. You know, the theme being this hindsight in 2020. You know, there's so many themes that have gone on this year. I mean, I think most of us would agree we've lived at least 2 or 3 investing lifetimes just in 2020 alone. So, I mean, I think the most logical place to start off, you know, if we're looking hindsight 2020, is the COVID trade, you know, as investors, and how we were to think about everything. How it changed everything. Changed not just from investing, but just everything. So, you know, I'd love to kind of let's get a little reflective on that. You know, take us back to that March 11th. It was March 11th when everything then shut down, and then I think the actual bottom was March 18th. So, you know, let's take us back to that time, and then maybe think about some of the lessons learned from that. So, who wants to start? Stephen, Kevin, Gary, whoever takes himself off mute first.
Yeah, I mean, I remember that evening specifically, was having a drink out of the bar, was watching, or I just had provided notice that the basketball game had been suspended. And then Tom Hanks tested positive. So, you know, across the board, that's when it really got serious. And you realize that this would begin to affect actual day-to-day life. You know, when the basketball game NBA is suspended, our most beloved actor in the world has it. People are beginning to die. I was in New York at the time, and you have people who are in the hospital. Things are surging, and the effect it had on the markets at that point, which really, you know, when we think about the grand scheme of things, that's the last thing you want to worry about. When really you want to make sure that your health is most important of you and your loved ones. But as it affects what we do day to day, you know, there was really no bottom in sight. And, you know, you could look forward and understand that things could get a lot worse. And there was so much uncertainty that you just didn't know what to do, right? So should you sell out things? Should you begin to hedge something? Should you try to get in cash? Should you not do anything? Just bury your head and set aside? And ironically enough, if you would have just not done anything, 6 months later, you probably would have been up on the year. And we can get into some of the timing and how quickly things turned around and why it turned around. But it was a time of the highest uncertainty that I've ever had during my experience as an investor, which includes during the financial crisis, because the financial crisis was not affecting your day-to-day health of everyone potentially in the country. And so this was completely different. You had no idea what was going to happen, how quickly the Fed act, what the government was going to do. There was obviously not a high level of confidence in the administration to tackle this at that time. So it was scary for sure, and it was nice for me that I happened to be sitting in the bar having a couple drinks. That was the best thing to do at that particular time.
Yep.
I think
Gary?
drinking was a theme for 2020. I remember that I was selecting, I was going to the local Bottle King here, and I was selecting the craft beers I was drinking by their percentage ABV and trying to match it up with the market movements for the day. So there were some strong ABV IPAs that were drank during the time of March, and I think there was an 11% day, which I had to look a little bit harder and find the right exact one for it on the down or up. I mean, like I was just trying to make sure that whatever I was drinking was matched up and consistent with the market movement for the day, and so that was a pretty consistent theme of mine. But yeah, I mean, 2020 is, I couldn't have predicted it. It's something I'm never going to forget, and I just hope we don't do it again.
Yeah, I think when we started these TIRs, Bobby, the commentary right from the very beginning was that the issue was created, and it created certain anxieties and certainly quite a bit of uncertainty. I think that was the word that's been carried over the course of the time during these conversations that we've been having, is one of uncertainty. I remember Yaron was talking about this idea of COVID premiums and COVID discounts. I think that's something that actually did come into play. The interesting thing to me is the speed of the recovery. I thought it was dramatic. It's actually unbelievable when you really get down to it, is that the level of fear, the level of uncertainty, and to come out of this thing with a market that's even significantly more, I don't want to say stable, but certainly the prices are ridiculously high these days. So it's really fascinating when you look at the entire perspective of 2020. It was a massive crash, if you want to use that, and then a significant recovery. Just, and again, it's pundit was sitting down saying, oh, it's going to take forever. I don't understand how you can listen to anybody anymore. When they sit down and say, oh, I know what's going on. I know what's going to happen. This thing's going to be, blah, 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 fill in the blank. And it just fascinates me how wrong people can be when I think that they're overwhelmed by politics and some of their decision making, but rather than looking at this thing as being, again, I've talked about the innovation cycle quite a bit, and it's still going on. I mean, we still have lots and lots of different things going on. Now, granted, some of it will slow down and some of it will be impacted, but people are still innovating, people are still trying to create businesses. Grant you that that when you look at small businesses and non market type companies, the discussion is going to be significantly different. But again, I think my general sense of it was, 2020 in hindsight was remarkable, just because of the fact that it recovered so quickly.
Yeah, I think people had a really hard time in March because there were three different things going on, and in terms of from an investor's perspective, there was the virus, there was the economy, and then there was the market, and a lot of people were focusing on the virus and the economy, but that didn't necessarily tell you what was going to happen in the market at a certain point. And I think people, their businesses, their year was essentially determined by what happened in March and how quickly, if they were wrong about the market at the end of March, how quickly they chose to admit that. And I think that basically, how you thought about that and what you did, either it was make or break for your year.
I'll tell you what I did back in March. I shifted my portfolio significantly. And what I did was I banked on the idea of COVID will become the dominant theme throughout the year, and started to get involved with companies that were in the immunology business, mask businesses, things of that type. And that was a choice that I made, basically follow the COVID. I had no idea what was going on, but I presumed that people would be dumping a lot of money into COVID related things. And of course, that choice was very fascinating because you watch the rotation and how things moved throughout the COVID space. When you started looking at immunology types of companies, and then masks companies, and then needle companies and vaccine companies and things of that type. It's very fascinating to see how quickly the thing moved from one subsector to another. And that was quite a remarkable observation, just staying in one particular market and watching how the thing shifted over time and how things that were in favor in 1 month were disfavor or in disfavor probably 2 or 3 months, hence that. Again, you look at something like mass companies like APT, which I don't own any longer. It was running, and all of a sudden right now it's back to stable, back to the same old business and things of that type. So it is kind of fascinating to see what's going on. And of course, now we're looking at vaccines, and we're looking at antibodies and a variety of different things that are going to come to I don't know what the could happen, but they're going to be looking at the idea of vaccines. So again, the whole thing has been shifting. If I made a decision, sit down and say, for example, to get out of REITs, which I don't invest in anyway, I mean, I don't know where I'd be sitting right about now. I just haven't got a clue. So it's pretty fascinating to sit down and look around, and you have to shift with the market, in my opinion. And I think that's might have been a benefit to some people.
Yeah, and with regards to the market as a whole, I don't think we can underestimate the power of all of these people at home, not working or working remotely, receiving checks from the government, and in some cases, enhanced unemployment benefits, looking to gamble. And they used the market to do that because there were no sports at the time, right? So people who generally would invest in, this is where Dave Portnoy came from, which fine. He used the market as a way to, basically gamble that others did too. The Robinhood effect, which I'm sure we'll get into, was huge here. And, when you think about why the markets turned around so quickly, clearly Fed intervention, the building on the things and programs and history from the financial crisis allowed them to act much faster. But also you have all of these people, young people, early 30 and younger, with a little bit of cash, opening up new accounts, speculating. And that had a major effect, I think, on the on a lot of these companies that were operationally we otherwise would not be investing in. But it also had a major effect on the psychology and the mentality of the market. And these things kind of built on itself, and that allowed kind of CNBC and Bloomberg and everything like that to then show, hey, look, markets are doing great. Let's present a more optimistic and rosy picture, when it was not led by the operational performance of the companies or their prospects in the near or midterm.
I agree with you on that entirely about the effect of at-home investing and Robinhood. It did have a dramatic impact. Again, I think there may very well be some interesting long-term studies that are done in hindsight to see whether or not that's an effective support for the market, or whether or not it's a disincentive.
Well, let me ask you this question.
It's interesting because the smarter that you, 2020 is an interesting year because, like, you almost had to. It's funny because you almost had to give back like 30 or 40 IQ points if you had them, in a lot of different ways, because in order, like, it was a very easy year to like sort of outsmart yourself or to outthink yourself and to do the wrong thing. Boy, I don't know what that says about us, but it was funny because it was like, now everybody's watching, like sort of when your neighbor who you think you're smarter than is getting richer than you, it's really, really hard not to do the wrong thing.
Yeah, but does it piss you off?
I'm a big believer that envy is one of those things that like isn't like Charlie Munger once said that envy is the only one of the 7 deadly sins that isn't any fun to do. So like, and I kind of think that that's right. So like, I'm kind of of the mindset that other people will always be getting rich faster than me, and that's not such a bad thing. I don't really. Once I learned to give up on that, it didn't really bother me so much anymore.
Look, what I'm afraid of is you get all these people coming into the market. They're buying Tesla. It goes up 10 times this year. Other companies like that. And then they're going to continue to reinvest. It's just like gambling. They won their first round, right?
Yeah.
And then they're going to lose everything that they got plus some over the coming year. And that's what happened during the tech time period. That's what happened during real estate in 06, 07. And that's what's going to happen here.
Yeah, but a bunch of people were mailed checks from the government that they went off.
Whether the markets as a whole well or
not.
Yeah. Sorry, Stephen, you
yeah, well, the issue is, the next couple of years, we don't know what the markets are going. We don't know what what's that? Sorry, was I frozen? But
it was for a quick second.
Oh, sorry. So we don't know what the markets are going to do, but over the next few years, a lot of these high flying companies from this year, there's no way they can keep up. And it's highly more likely than not that these will be the ones that crash. And these are the companies that all of the retail investors piled into. And when they're buy options, when they make speculative bets in the short term, that's when they're going to get screwed, lose their money, and realize, that the speculation and gambling is just like these other prior bubbles.
I don't think that's such a bad thing. I mean, if you're breeding a whole new generation of investors, and they got to learn the lessons just like everybody else, right? I mean, like, that's how you learn. I mean, everything I've ever learned is because I've lost money in one way or another.
Yeah, I don't know
you
if
guys.
it's good or bad. It just is.
Yeah.
But I think that's an opportunity for us. And when you talk about envy and how your neighbor did really well because he owned a speculative stock, during this time period, you just got to say, look, more power to you. Don't think that that's replicatable, though. And for us, when we're here for the long term, trying to survive over 20, 30, 40-year time periods in the markets, you can't chase that stuff. And you got to be really careful to not get caught up in that psychology.
Will you be shorting some of these things, these relatively well-known, high-flying unicorns that don't have anything fundamental to sit on?
It's a good question. I don't know. Timing would have really screwed you, though.
Yeah, and take a look at some of these electric vehicle or EV companies that are out there. They have $100,000 in annual revenue, yet their market caps are $2 billion or some number. Again, I can name names, but it's not worth it. I mean, I think we have to recognize now many of these things that exist, and many of them are micro caps. Some of them are still doing the dog and pony shows. So it's really fascinating to see how you might even be able to identify some of the sectors that could come crashing down very quickly.
Well, here, we already went into this a little bit, so I want to get into this Robinhood effect, and I want to ask you all, what you think is the sustainability of this effect. I think you kind of more or less answered it in a way where, look, you're going to have we're not here to say that everybody who opened a new account this year on Robinhood is a speculative investor. There's going to be real investors that might lose a little bit, but then, survival of the fittest, Darwinism, and stick around, learn those lessons and get better, but what is the Robinhood effect on the market now as we move forward here? I mean, is it real interest? Is it sustained interest? What's happening?
You got to look at Robinhood a little bit differently. I mean, ultimately, I think what's happening is that there is an impression that it's full of crazy people. But when you look at the top 100 names that are invested by Robinhood, they're solid names. I mean, for a long time, I mean, we talked about this in the past, for a long time, Ford was the number one issue that was supported. Then again, you look at AMD. I mean, AMD is probably.
And maybe they were giving away the Ford stock, though. When you
that's what it was. At $3, whatever it was. Yeah. So in many ways, I don't know whether or not the Robinhood effect is a bimodal effect where you have a bunch of people who are indeed looking at it as a long-term investment, trying to find some stable companies, trying to secure a future, and then there's the other people who are running it as a speculative opportunity. So again, there may be modalities in Robinhood that will differentiate over the long term.
I sort of think the Robinhood effect, like, it's maybe that's a broader name that's applicable to more than Robinhood, but I mean, like, the Robinhood specifically, I mean, I see estimates that Siri wants to tell me the real Robinhood. The Robinhood, they've got, I mean, the best estimates I've seen is that they've got $20 billion out under management and the average account size is $1,500. So I don't know, it sort of feels overstated to me. I just think it's just, I
actually think that, Gary, that's a really good point, is that and I think that was a good clarification, is that the Robinhood effect is it's more than just those who signed up for an account on Robinhood. It's kind of this overall idea of speculation, and some of what Steven said, this, transfer of sports gambling to stock market gambling, and I think it has that. You could call it the Robinhood effect, the Portnoy effect. I don't know if there's a combined term for that, but I think it's just more or less that.
It could be more Portnoy because he embodies, and I think he, net, he's probably, I think all of this and he is probably a good thing. And I don't mean it because I think that speculation is a good thing, although it's not necessarily a bad thing. It's just that you're getting more people interested in investing and thinking about their financial lives and the future. And even if they lose like if you get a bunch of millennials and Gen Z people who wind up getting taught some expensive lessons, that's such a bad thing. And you've bred another generation of investors. And I don't think that's such a bad thing either. I think that, net, this is all good. I mean, there's going to be some bad things. There's going to be some things that, make you scratch your head and go, I don't know why that happened. And, as a seasoned investor, it seems a little crazy to me, but like, I don't see why this is such a bad thing. And I would even wrap that into like the SPAC stuff that we're seeing, like we're talking about review in 2020. There's definitely bad stuff going on there, but I don't know. I think more companies coming to market and coming to market sooner, like, I think that net that's not such a bad thing, and a lot of them will blow up, and
I'll take the other side of that. I think I agree that it's good to get more people interested in the market. I think the negative comes in with the mentality that the market is a gambling kind of mechanism that's short-term. I don't want more short-term oriented people in the market. I want people coming into the market who understand that buying a stock is buying a piece of ownership in a company over the long term. I don't want them coming in as day traders. And I don't think that's healthy for the market. And I think that leads to this increased volatility and misunderstanding of what these companies are. And what I worry about is these day traders who come in, who lose money, these speculative types of things. This happened in the financial crisis, happened in the tech bubble beforehand. What I worry about is then that leads to additional kind of government-oriented protections, government intervention, rules and regulations on businesses that have something to do with kind of the ownership side of it and not the actual freedom of them to operate in the way that they see fit over the long term. Look, we're going to see this. We already have the subsidies and other government interventions for companies like Kevin said, the EV companies, when Tesla crashes, when it crashes, if they don't actually if they don't do an AOL Time Warner type merger, which I wouldn't be surprised if they do, but if they don't do something like that and Tesla crashes, there will be government intervention because so many people and so many, small retail investors own a piece of Tesla. And that's what I'm afraid of.
Yeah, I mean, Tesla's so interesting, and full disclosure, no position one way or the other, and I've never had a position one way or the other in Tesla, but it's such a fascinating, like that's almost like a that should have its own like 10-minute sort of what happened in Tesla in 2020, and then the whole Tesla Q crowd on Twitter and everything else. I think it's super fascinating to me because like having no position in it, like I'm on the one hand rooting for Elon Musk to be a huge success because I think net that's probably good for humanity. On the other hand, like I look at some of the things that are going on there, and I go, well, geez, the accounting, oh my, the accounting, and we're being very promotional and we're doing all these things that I really don't like. It's just there's so much wrapped up in Tesla, and then you have just the fact that it went, I don't know, I don't have a quote up on the screen, but it went bananas this year, I'll say.
Do you want to invest in a company that has so much key man risk? Let's say something happened to him. Let's say he goes to Mars, right? He wants to go on the ship and to go to Mars. Let's say he catches Corona, which he probably already had, it sounds like. And something happens to him. He gets debilitated. Think of any other company in the world, including Warren Buffett and Berkshire Hathaway, that would have such a great effect if he was no longer there. If he was no longer there, there's no company, and this is a Fortune 500 company. Yep. This is an S&P 500 that a wide range of people have ownership stakes in. And that amount of key man risk is absolutely insane.
The interesting thing that I was considering something just the other day about whether or not Tesla investors actually are buying entertainment as part of their investment. It's quite fascinating. And right now I'm running a poll on Twitter as to whether or not people consider Tesla to be either a car company or a software company. The what?
A poll at the Good Prick on Twitter.
Yeah, a poll. And it's really, is Tesla a car company?
Looking for it right now.
Is Tesla a software company? And the fascinating thing about it at this point in time, it's basically 50-50. Some people think it's a car company and some people think it's a software company in equal fashion, which is shocking to me because what it says is that nobody knows what the company does. Okay, literally, it's a funny game.
I just voted software company.
Oh, okay, good for you, Bobby.
You got some votes on there though. You got 17 votes. This is good. This is
Yeah,
good.
that's
Good engagement.
I don't get a lot of votes, but I think that it's a small representation.
Yeah. I mean, I think the overall theme that at least I would love to see for 2021, especially on the Robinhood side, is just more educational materials. Because one thing that you could argue for all the other platforms that it wasn't just free to trade on is that there was that barrier to entry where that you did have to pay whatever the fee is to make a trade, and when you take that out completely, you're just allowing people to maybe go in, make a speculative buy or sell or short or anything like that with really, I mean, of course there's the high risk of you losing your investment. That's a huge risk, but the barrier to entry to go and do that is completely taken away. So at least my hope is for 2021 is that they invest a ton in education and making sure that they get those materials out there on a consistent basis.
Have any of you guys read any of the regulatory stuff on Robinhood, like the Attorney General of Massachusetts filed a pretty lengthy suit against them, and then the SEC also had a pretty big settlement with them. Did you guys ever flip through that?
Yeah, I did. I just pulled it up right now again too. But
the Massachusetts one is actually more interesting than the one the commission had. I mean, the commission got a good chunk of change from them for disclosure of the order flow stuff. But the Massachusetts one was like Robinhood designed themselves to basically be an almost like an addictive gambling thing. So there was one part of the Massachusetts complaint where I guess if you wanted some sort of trading feature on your account, you were like in a contest with all the other Robinhood account holders, and it was like you had to tap there 1,000 times, and then you would get this feature enabled, and you would get bumped up in the queue and whatever. And so they're literally trying to train people to go on their app and just start tapping as fast as they can. And it was just like it reminded me more of like a cigarette company than a brokerage company, and they're trying to train people to get these digital dopamine hits.
That's
crazy.
Kind of fascinating because what they're doing is they're suggesting that it's a game.
Yeah, it's a gamification. Totally.
Yeah. All
right. So I want to move to some other themes that happened this year. Some more hindsight is 2020 type themes from an investor's perspective. And Gary brought this up a little bit, and it's SPACs. We did a full episode on SPACs here. I figured maybe we could cover that a little bit. And, Gary started getting into it a little bit here where he was talking about how, that's has potential positive effect on the markets, and that some of these smaller companies are now going public a little bit earlier in their life cycles. So let's review this a little bit. SPACs was a craze this year. So what are your thoughts on that? Gary, you started off, so I'll go back to you.
I've sort of mixed feelings on it. I said I think that net long term, it's probably not such a bad thing. But I'll tell you, and I'll frame that in the context of sort of these VC unicorns that are sort of coming to market. The VCs, because there's active secondary markets in some of these biggest investments that they make, basically are able to hold these companies until they're almost fully mature. And so, as a public market investor, I don't really love that. But anything that gets companies talking about coming to market, maybe a little less fully, it makes more of a market in some of these things. I think that more opportunities are better than less opportunities, generally speaking. That doesn't come without risk, obviously. Some of these are going to blow up and people are going to lose money. And but I think that net, holding companies private longer, I don't know that that's such a good thing for the companies. I don't know that that's such a good thing for the market. And so, just getting companies out there, sort of and investable generally or sooner, I don't think that that's such a bad thing.
I mean,
I
But are you investing in the SPAC, the potentials of acquisition? Well, that's what seems to be happening. Are you investing in
yeah.
the
So I
company
mean, I've sort of dinked around and traded with some of them, but not really. I mean, like, there a lot of the SPACs themselves, I kind of just view them as trading sardines for the most part. So I've sort of just dinked around with that, and as opposed to the eating sardines. And I that's just not a way that I'm wired to invest. Like I'm not going to be very good at owning something because I think it's gonna be a really sexy story and it's gonna go bananas and that kind of thing. Like I'm just not really wired that way. That's not what I'm good at doing. But as an observer of it, like I'm glad that more companies are thinking about going public earlier. And it bugs me that some of these companies, these recent high-profile IPOs, the Airbnbs, the DoorDash, we don't own them. But it bothers me that it's $100 billion valuation is the first print, and I would much rather have a broader opportunity set than a narrower one. And so I just like on the whole, I just think it's not such a bad thing.
I agree with your commentary, Gary. I think that's actually provides some mechanism, an alternative mechanism that's not available to some companies because of the VC management of the company and how the VCs have changed their tune with regard to how they make their money. And again, you're seeing so many of these things 7 or 8 years come out afterwards, and they come out at very, very high valuations, and then not all of them, but some of them are really trashed, later on throughout the market didn't DoorDash, I don't look at it, I think DoorDash just lose half of its market cap just over the last couple of weeks. Something like that.
I don't follow it all that closely.
Don't know. But I looked at something like what again? I think that there's actually a similar entity or mechanism available in Canada to bring companies public, or at least to get companies established without having to go the reverse merger route that happens in Canada quite regularly. I forget what it's called, but again, it sets up the same way. It is basically set up as a means for the entity, again, I don't know the name, I don't remember the name, to merge with this new founded business or existing business and go public that way. So again, I don't think this is a new idea. The SPAC is not a new idea. I think it's been in existence in Canada for probably a few years already.
I think it's actually quite old. So I think the South Sea company of the South Sea bubble fame was formed as a blank check company whose primary purpose was to do something like to go pursue a profit opportunity. I forget exactly how it's written. So if one of you guys want to know what I'm talking about or can quote it directly, but like it was formed almost as a blank check company to go pursue profit opportunities that are of immense value or something like that. I forget what the exact one was, but it's like, but that's, I mean, we're talking about something that's several hundred years old, if that's indeed the case. I mean, I will take a balanced view on it though, because like these companies, they're choosing to come this way versus other ways. Well, why? Well, it's faster. Okay, that's fine. But you can make all sorts of forward-looking statements, which you're not allowed to do in like a traditional process. That's sort of a red flag. And like there's a couple of different ways that these companies can come to market now, and how these companies pick and choose to do it should tell you something about the company, and it should tell you something about the backers of the company. And these VCs all talk out of both sides of their mouth every which way on, this way is a good way versus a bad way, and there was a big pop on the listing, and we didn't get as much as we could. But like I've never heard of any VC complaining about the gap up in a Series B to a Series C funding round. So like what are you guys talking about? And then you have like companies that can do a direct listing, and they're like, oh well, at least we're not leaving all this money on the table. But like you don't have any lockup requirements, so like you can just sell everything that day if you wanted, or a lot of it that day if you wanted to. So like I just think that more ways to come to market is better, but it also there's an additional burden on investors to have an increased level of sort of skepticism and understanding the motivations based on the various constraints and things like that associated with each method.
Yeah, I think this is a direct effect of what happened with WeWork. and their S1 situation and everything during that time period, because now you have a number of companies like Nikola with the SPAC situation there. They would have attempted to go public via IPO if WeWork would have worked. And I think there were a number of other companies like that as well, that they don't want to be exposed to that type of scrutiny that happens during the IPO process. And this is really the history of SPACs. This is why companies generally went public via SPAC, in addition to the speed route. And, then it leads into this effect where there are a lot of sponsors, and the sponsors are going around now drumming up support. This is a supply side thing at this point. But I do think the catalyst for it was the WeWork debacle.
Right. I mean, I another argument I make is it seems that there's still kind of a fundamental change though in how companies are starting to think about what it means to go public, right? The investment banking world is completely changing. It needs to change, and as Gary was just talking about here with direct listings and now with SPACs, so how do you guys think about that? I mean, look, we also look at the microcap world, and there's a huge event coming up that hasn't really been discussed very much. And that's how a whole bunch of stocks listed on the pink sheets and the gray sheets are going to be gone. Okay. Unless they decide to uplist to, QB, QX, NASDAQ, NYSE, or one of these exchanges. I mean, that's a pretty big deal that's coming. I don't know. Anybody have thoughts on that? Or also see that? Do you guys haven't seen that news?
Yeah. So, the point there is that the brokers and the regulations related to the brokers, right, are going to limit that availability. And they've already been harassing microcap investors the last couple of years. So, the regulators have, and some of the brokers. And so that does make it more difficult. And some of these companies don't have the growth potential to uplist, or don't have the asset base to, spend that overhead every year. And, it is a little bit disconcerting for those of us who've played in that area previously. And it creates this bifurcation in the market that is disappointing. I agree with Gary that we want more companies to be public. That's been the problem over the last 20 years, really since Sarbanes-Oxley, that there have been a significant decline in the number of companies that are public and become public every year. And I think all of us want to see more public companies. We want more options. On the other hand, though, there are more opportunities to invest in private companies. Forget about those who have already been listed at some point, but private companies through crowdsourcing, crowdfunding, and other things like that. There are more opportunities to do that now than there ever have been. A typical investor could get access to some sort of VC type thing if they have the ability and intelligence to do so, which is, so the market has just shifted in some ways to a different area. Whether it's more safe or not, that's where the government, I think, is intervening in an unfortunate way.
Bobby, you brought up a comment early on about how do companies change, and is the idea of remote working going to be taken as a normal course of the events in the future? A variety of things of that type. I mean, we talked about changes of culture as a result of the impact of COVID. We talked about a variety of different things. I know that we have talked about it, you and I and Stephen, but I didn't know whether or not Gary might have a comment or so, or an observation of that.
On what specifically? The culture of companies, or
changing, how companies might be changing? Again, if the idea of work from home is taken on dramatically, it means that people aren't going to be working in offices and things of that type. That's going to have an impact on office leases and things of that type. It's going to have people moving around, which is something we talked about in the past. I think how does the idea of these COVID-inspired changes play out over 2021, 2022, et cetera?
I think the things of the world where it's being done this way because it's always been done this way and we haven't rethought it. Like, I think that there's probably sustainable change that occurs there. I think some of the stuff that's purely COVID related, and you could make an argument to do either thing. I think you have to just sort of orient yourself a little bit more towards the incentives over the longer term. And that doesn't mean it won't take some time to get back to whatever the short, it won't take some time to get back to whatever normal used to be, but I think that you probably will. So, in terms of like the work from home stuff, I think it's reasonable to assume that working from home will be more socially acceptable, but I think it's less reasonable to assume that it can be all the time. And so I'm an owner of a company. I can tell you that I would much rather see my partners in person than talk to them on the phone. And I can tell you that we try to be innovative as a company, which in financial services is hard to do because it's not financial services. There's not actually a lot of innovation that goes on in traditional financial services, but it's really hard to do when you're all remote. And I can tell you that that what we plan to do, the stuff that we can think about and plan and say we need to do X and X needs to happen, like that's really easy. Like you can do all that remotely because doing things remotely that you need to do is hard. It's all the other stuff that's more challenging. Like it's being able to walk over and say, hey, I'm thinking about this. What do you think about it? And I can see that you're not really on the phone or whatever. Whereas if I'm picking up the phone to call Eric or Steve, it's sort of, I'm interrupting what they're doing. They need to, it's way harder to have what would I call some sort of
organic or something.
Yeah. It's hard to plan and plan time. You can plan time for some of that stuff, but even that's not that great. So it's like, I don't think work from home is all it's worked up to be. And we've been set up to work from home since the beginning, and we did it probably 3 out of 5 days most weeks, and that was fine. But you still need to have a certain amount of in person. So I think that, and I don't know if net that reduces the need for office space or not. And the other thing I'll say about it is, in relation to travel, I think that people will work from home and travel less until somebody that was in the office got a promotion instead of them. Somebody who got FaceTime with the boss got ahead in their career. Somebody that was going to go make a sale that sent a Zoom invite to make a sale, lost out to somebody who actually got on a plane and showed up. And once that starts to happen, you'll see people in suits again. You'll see people in planes again. And I don't know how long it's going to take for that to happen. I don't think it's going to go back to 100% of what it was. But I do think that where we sit today is not where it's going to land. And so I don't know what the investment implications of that are. I don't know if I would buy New York City real estate or not, or whatever it is. I haven't really thought that through. But I can tell you that it's not the current status quo. I don't think you can say that this is what it's going to be. I think that the most acute things people think they're most vivid, people tend to extrapolate those out the farthest, and I just don't think that's.
Yeah, and human trust. In order to build trust, you need human interaction and connection. And the best way to do that is in person. And the second best way is video, seeing each other. The third best way is voice. The fourth best way is written. The fifth, et cetera, et cetera. And so ultimately, like Gary said, to make a sale, to any industry that requires trust and interaction, that's what business is. Essentially, that's what capitalism is a web of trust. And in order to do that, those who are willing to have that human interaction are going to be the most successful over time. So it will at some point get back to that. To the degree it previously was, who knows? But that is what is required to be successful and get ahead to make sales. And so to Gary's point that, people don't want to travel as much for business, fine, but then there will be one person in the office who does, and that person will be more successful. And then that will require everyone else to go back to traveling for business.
Yeah.
I think that's well spoken.
So, okay. So, I think we covered more or less the main themes that really encapsulated 2020 from an investing perspective. Was there anything that we missed? I think we talked about the main ones. Did we miss anything? Anything else that pops in your head from our conversation that's happened?
Well, I think government intervention, the Fed as well, and what that means for the future. And,
Should have had Adrian on here.
Yeah, and inflation, are we going to have inflation? Is that going to prop up whether it's Bitcoin or gold or other commodity type of things over time? And once demand comes back, what does that do for the price of oil? What does that do for other, aluminum, other copper, things like that? That's an interesting theme. I don't have answers for that, but the fact that we have so much liquidity in the market, but with that liquidity, it's tied up. It's not currently going into inflation. And will that happen at some point or not? My friend Keith Smith at the Bonhoeffer Fund has a very interesting argument that there is likely to be, his argument is that there is not likely to be inflation over any time, any serious time period going forward, because we're in an environment where progress has advanced so rapidly and will continue to advance so rapidly that the cost of production has gone down so much that is that deflationary side of it is a competing element to the additional money that's in the market, not even money in the market, but the liquidity that's being created here. And so you have a balance net that is actually deflationary because of the advancement of the society and advancement in technology. So, I don't know the answer to that. I think all of us are kind of afraid of all the money, the 0% interest rate stuff, negative interest rate in Europe, all that liquidity in the markets and where that's going and what bubble that'll pop up. But I don't think that's a one-step kind of result. This is a second, third, fourth level thinking thing here that I don't think there's a way to really feel confidence in a prediction.
It's a really interesting argument. Anybody have any thoughts on that? I'm still processing that one.
Yeah, we should have Keith on at some point to more fully flesh it out because it does make sense if you start to go second, third level thinking on it.
Yeah, Gary, Kevin.
I generally agree with that argument. I think that's the natural state of affairs is for competition to drive down prices. I think that it's unique when that doesn't happen. And so who controls pricing is one of the more important questions I ask as an investor in anything. My pushback on that it's not going to come back is that I think everybody likes a little bit of inflation. So if they put their mind to it, I do think that the government, if they wanted to, could create it. And I don't think that the Federal Reserve can create it. And if they think that they have the tools to do so on their own, I would wonder why they haven't been successful to this point in creating it, because it's been an explicit goal that we want inflation to be 2%, and they haven't hit that number since they've stated that goal. Maybe they touched it once for like a quarter. And so, but I do think that the federal government, if they wanted to do that, could. And so I do think that we could enter a world where that happens, where Congress or whomever starts to think about building that into the economy. And that can happen in a variety of different ways. It can be a universal basic income. It can be earned income tax credits. It can be government provided jobs, guaranteed employment. It could be all kinds of different things in various shapes and forms. But I don't know that we're going to see it until that happens. And I sort of wonder if, so there's not going to be any structural inflation until that happens. You could also theoretically have in a debasement event is also on the table. And I think that that's similar to FDR in 1934 when he confiscated the gold at $21 an ounce and then repriced it the next day at 35. Or in 1971 where Nixon took us off the gold standard, and that set the scenes for 70s style inflation, which was kicked off by US defaulting on its currency, which is what happened when Nixon took us off the gold standard. It was the US defaulting on its currency. And so I think you can have an event like that as well. So there's a variety of ways that we could see something, but I don't think it's going to be Federal Reserve keeps interest rates at 0 and that gives us 70 style like that. I don't think that that's in the cards. But I do think that if they got it in their head that that was an explicit goal, and it wasn't the Fed's goal to create 2% inflation, but Congress's goal to create 2% inflation, I think that they can do that in conjunction with the Fed. So we'll see. I don't know. So that's sort of what I keep a lookout for, because sending money to people whose marginal propensity to consume is 110% is going to be inflationary. But those people, as laborers, have no bargaining power. So it's not going to come from that side. It's going to come from the federal government wanting to do it.
Well, I think the triggering effect essentially is if the U.S. dollar loses its reserve currency status, because then you have a government crisis in terms of the debt. But look, this is not the most exciting conversation here, so I'm happy to move on from it. And we can talk stocks a little bit more about, COVID here. But, none of this stuff is going to happen tomorrow. I don't think any of us think that. But at the same time, you want to look at companies and look for areas that are going to benefit either way. And I think as we look at things, even through COVID, there are companies that have some sustainable brands and pricing power. Forget about the historical brands like Coca-Cola. We're talking about brands today that have pricing power, and in some cases a monopoly effect, and that could be a Google, Apple, Facebook, et cetera today. And those are the types of companies that have done, probably will continue to do very well during these tumultuous times, COVID and in the future. So, that's the kind of interesting thing to look at. How does COVID affect it? And does that drive more like types of advertising and things like that online over the next year or so? And if so, then those online advertising companies are the place to be as an investor.
Kevin, you have anything to add there? Very good. All right. Well, I want to get into the final topic today, and that is really, what some of these themes and what we've seen in 2020. We already kind of started getting into it a little bit here, but I think those are more implications for maybe 2022, 2023, potentially. But with the speed at which everything is happening, who knows? That could have an effect on 2021. So I'd love to get everyone's thoughts on, what some of these themes and the things that we saw in 2020 from an investing perspective, what some of the implications then it might have for 2021. I'm not asking for a crystal ball or where you think the market's going to be, but just what might be some carryover that could have some effects that maybe some people haven't thought about yet. So
one of the things that I'm looking at right now is the long-term impact of the shifting that's going on in the automobile industry, and how the EVs are actually becoming much more apparent to many more people that they are going to become part of society. Again, it's just, I think that the sentiment for EVs has changed. I think there's a lot to do with that as that innovates more and more and more, there's going to be significant more opportunity to participate. Again, one's looking at automobiles themselves, you're looking at batteries, or you're looking at the minerals that are required to make the batteries. I'm just picking up one particular topic, and I think that something like that will have again, I'm looking at innovation, and indeed, I think there's going to be quite a bit of that. And again, I don't know all the different markets, so I just pick on that one because I think there's going to be again, 2021, 22, 23, there's going to be a lot of stuff going on in there. I think there's probably going to be offshoots from that as well. I mean, you look at the LiDAR, way in which LiDAR is being used to run automobiles. If LiDAR is going to be used to direct automobiles, then where else is it going to be used? I mean, there's a whole host of things that are going to go on, and I think it's going to spin out all kinds of opportunity. But I don't own anything, by the way. I do own graphene. I think graphene is unbelievable stuff.
Like the physical graphene, or you just own a graphene company?
Oh, I don't own physical graphene, but I think graphene.
Okay.
I put together something about graphene. If you remember how in The Graduate, the guy turned to the young man and said, "Plastics." You recall that at all? The same thing is true right now about graphene. I think there's a significant opportunity. If you read into this thing, it's like, wow, it's one of the most incredible materials that's been identified in the last 30 years. So I think there's great stuff happening, still happening.
I'm going to raise my hand and ask a question. Because I don't follow EV stuff for the most part. What's graphene and?
Well, the biggest issue with EV right now is the duration of the charge, how long it holds the charge, and how fast you can charge. Okay, if you can charge in the same amount of time it takes to fill your gas station, to fill your gas tank, everybody will start to sit down and be a lot more comfortable about it rather than sitting 45 minutes on the side of the road someplace in a Flying J type of place. I mean, I don't think that really is much. I don't think that's going to give support to the idea of wholesale change. So I think that in EV, you have to have a significant major alteration, and the major alteration is in the way the batteries work. And the battery technology is there. This whole thing, this graphene material is like holds 30 times the charge of anything else. It's just dramatic. So I think this, when you look at this whole area, as I said, I've been reading a lot about EV. It's ripe for significant opportunity, in my opinion. I don't know if I'd buy Chinese stuff, but I would be very fascinated to find out. Even Tesla again, many of their new batteries are all graphene based. So, what is it called? Their power stack, the one that's in the home. But again, I think this when you get into the technology and the innovation and things that's going on, as I've said to a number of different times in these TIRs, is that the innovation cycle does not change. It does not slow down. And I think that's probably one where it's going to really pick up considerably, particularly when states and governments begin to force you to do away with the ICE, the internal combustion engine, and replace it with some sort of electrical. Again, it's one area that I'm looking at long term.
By the way, I can attest to the waiting the 45. My mother-in-law just got a Tesla, and they drove somewhere. They didn't realize they had to wait like 40 minutes. They were late for something because they had to wait 40 minutes for it to charge.
Try charging it at home with the 115 volt. It takes you like 2 days.
Yeah, they just installed that. Yeah.
If you get 220, it's going to be overnight. So these superchargers are the. And again, you look at something like that. You look at Blink, which I don't own. Any of these charging stations, they're going to be just stuffed in everywhere, and it's going to be incredible as to what's going to.
Why would it gravitate towards that instead of making the battery easy to swap and just you have battery swapping stations?
Why would you want to do that? Why would you Why would you change out your gas tank every time you fill your?
Well, if it was easy to do, you would. Well, number one, because in order to have a bunch of filled gas tanks sitting around takes up an awful lot of space. I would think that having a battery you can swap is a lot smaller.
Well, the batteries, for example, in electric vehicles, span the width and length of the space between the rear axle and the front axle. There's a ton of them, and also, again, I don't think it's a very effective means. I think what you have to do is produce them so that they last a lot longer, like the length of an ICE. They're easy to fill. It's the habit. What's happening, electric vehicles are changing the habit of the way in which you operate your vehicle. Okay, you have to look at where you're going. You got to plan for where you're going. It's not one of those things where, oh shit, I'm running out of gas. I got to stop over here, and there's 6 gas stations right there. You have your choice. I have a friend who has a Tesla, and he wants to drive across the country. He has to plan. He has to make sure he goes exactly where the charging station is, so he doesn't stop in the middle of the road. So again,
that sounds mildly inconvenient.
The what? Sounds
mildly inconvenient.
Yeah, it's mildly inconvenient, and I think that basically is a barrier to most people who are looking at how they're going to drive these. Again, particularly if you live in Texas, for example, and you're driving out in West Texas, there's not a chance in hell you're going to be wanting to go to an electric vehicle anytime soon. I think that lovely opportunities for what?
2021 debate.
2021 debate.
What will be the end of the year? Will we have battery swapping? Will that be the EV approach that takes effect, or will the charging power and speed of batteries dramatically increase?
I have another poll. I'm running on Twitter, by the way. That one is will Uber or Lyft be acquired in 2021? The funny thing about it is that most people sit down and say neither. And if they do say, they pick Lyft by a huge margin. So it's really I would agree with that. That's another story. What's the longevity of Uber or Lyft, given the fact that they have seriously suffered over the last, let's call it a year.
Or do they merge?
I don't think they merge. I think I don't even know who could. If
There's
somebody
little
buys
thing called,
Lyft, who's
Art
gonna
Scott
be?
Rodino, and I don't think that they would pass that review. That's the HSR antitrust review.
Yeah, I don't think that would either. You're probably right. But anyway, so I mean, is there any other implications for 20? I mean, we talked DV now.
I guess the question is, there's a lot of craziness out there. Have we seen how crazy it can get?
Thank you. That's what I'm talking about, because I'd written that. I actually wrote that at the very beginning, where I was like, look, we saw craziness happen this year. That doesn't mean we can't see it again. Not saying it's going to be another COVID situation, but this could happen again. And I hope that it doesn't happen on an annual basis. But yeah, Gary,
I just sort of think in the market, have we seen how crazy things can be? And the big debate that we're having internally is this 97 or is it 2000 or 98 and there is a 2000? And
look, I think, in the coming year, you're going to start having analyst estimates for 2021 and 2022 come out over the next 6 months. And any analyst reports and estimates over the last 9 months have basically given a free pass for any COVID related things. It's just, we're looking forward 2 years instead of 1 year. And I think as we get into 2021 and we start to make some estimates of post-COVID results, that's where we'll really see what's going to happen here. And I don't think those estimates are going to be good. I don't think those results are going to be good. And I think that's going to be a driver for some corrections in the markets later in the year in 2021 on average. Now, I think there's going to be pockets here where we really still can have some opportunity. But once we start looking at really post-COVID operational results and connect them back to where the stock prices are today, we're going to see what that disconnect is. And I think there's a strong potential for there to be issues then in the market as a whole.
Well, let me ask you a question then. So every company in the world right now has the opportunity to implement zero-based budgeting, right? Everybody's looking at their expenses and everything and keeping a keen eye on that and their cost structures. As you see demand go back, why couldn't you see margins be higher than they were pre-COVID?
Oh, they certainly could be, but how do you then continue to justify some of these companies trading at significant multiples to revenue that they can have those cost cuts, they can have that margin expansion, and they're still wildly overvalued? And I hate to keep bringing up Tesla, but might as well.
Yeah, no, I hear you. I mean, there's the famous, the Scott McNealy quote from Sun Microsystems at 10 times revenue. And they were asking about a stock price at 10 times revenues. And he's like, well, to get a 10% return, I have to assume that I have no overhead. That's hard with 12,000 people. And I pay no taxes, which is kind of illegal. And, all that sort of good stuff. And you have famous VCs out there saying, these companies at 40 times revenues, it's an opportunity and they may normalize at 10 times revenues. And I there's a large part of me that thinks that's absolutely not sustainable for sure. Or I shouldn't say for sure, but a large part of that is not sustainable. But you'll have one or two companies that maybe that is justifiable in the end, but it's not going to be all of them, and it's not but you have a lot of them acting that way.
That's the issue. I think there will be some that do grow into those valuations for sure, but I think as a whole, those who are going to grow into like DoorDash, for example. If we're talking about $100 billion valuation for a food delivery company that 2 years ago was not a dominant player in any way, I'd be worried about that type of sustainability. And there will be companies that grow into it. There will be, those visionary leaders that are able to defend that moat there that they've created here. But, for the most part, I think this is market driven and not operational driven. And there will be a correction at some point for those companies that aren't able to support their valuations.
Yeah. I think it's interesting. I wonder how much of it is right now. It feels like there are certain silos of that going on, but it doesn't feel as pervasive. I mean, we pay very close attention, so we see it basically everywhere, but that's because we're paying very close attention to certain pockets of things, and there's certain things that just seem more obvious And because they're obvious, it seems like it's, crazy everywhere. So I just sort of wonder if we've seen how crazy it can get across the spectrum of things. You know what I mean?
Yeah, it can certainly get crazier. We've seen that in history, and when that craziness will end, we'll see. Certainly we could continue this year and the next year and the next year. For me, I think there's some bifurcation in the market. I'm interested in those areas of the companies. There are a number of companies that just have not ridden that wave the last few years, but are quality companies that trade at reasonable prices, that have strong balance sheets, that are trading at book value or below. Quite a few smaller companies we're involved in. I know Gary as well follows these, and Kevin. So, that's the area I'd feel more safe in, even if that means lagging the market for a certain time period, because in the long run, those companies are more sustainable, those stock prices are more sustainable, and will come out ahead over the long run without taking on that short-term risk.
You're arguing for stability in many, many ways. And I think that's kind of one of those long-term investor goals, is to find those opportunities where you have, as you said, a quality operation that is sustainable over time and is capable of being able to weather the ups and downs that exist. So, again, we started talking about the craziness that exists from the Robinhood types, or whatever it is, speculators. And now we're basically talking about what I think long-term institutional investors want, and that is stability of a definable type that gives them the opportunity to see their growth, in short-term spurts rather than something that's going to be, overnight. Again, so again, it's still kind of interesting to me, though. However, there's that. I think companies are operationally still trying to determine whether or not this uncertainty is going to be going away, or whether or not they're going to have to live with it for a longer period of time. I think that's going to be the differentiator between, as you were saying, Stephen, between a company that's well managed and well funded and things of that type. Can they project how their business could operate if these types of crazinesses continue?
I think it's really interesting.
Everybody can run out of money at some point in time.
I think it's really interesting that the market is what we're complaining about. It's sort of funny. Prior to 2020, I think everybody would complain about how short-term oriented the market is. And now we're now all these companies are being priced, as Stephen, you said, 2022, 2023 numbers. Now we're complaining about how long-term oriented the market is in its approach. And I just think that we're always going to be dissatisfied in that way. And so I guess the question is going to be, when does the focus turn more towards the short term over the long term, right?
I mean, that's a good point. I think the issue, though, is, hey, we're looking 2022, 2023, and how realistic are those projections? And right now, I think they're probably rosier than what reality will be. But, we'll see. I could be proven wrong.
I would even take it.
Hope and faith of the analysts. Yeah. It's it's like spring training for baseball. Every team thinks they can make the World Series, and then you get the cold hard facts of autumn.
Yep. Hey, Garrett. Oh, sorry, Gary. I would even take it a step further and say, we were complaining about there being not enough, I guess, participation in the market. And here we are saying, the Robinhood effect and millions of new accounts being open, and now complaining about that, So
before people were complaining about the 5 or 6 stocks that were leading the way and everything else was sucking wind. And, yeah. I don't know. Last I looked, the Russell 2000 has beaten the S&P on the year. So I wonder what the excuse du jour is going to be for some of these people.
Yep. Kevin, you were saying? Sorry, I cut you off. You're good? All right. Well, okay. I think this is a good place to end it. I will say I think this has been a very fascinating conversation. We'll use it as our time capsule when we do this again at the end of 2021. So, to close us out, everyone, tell us your New Year's plans, as elaborate as they probably will be this year. So Kevin, I'm going to start with you, and where people can go and follow you on Twitter.
Oh, God. Yeah, I'm at the good prick, and I'm actually active these days. So listen to what I'm saying. Listen to what I'm saying. I'm educating people. You'll become brilliant as a result of sticking around and paying attention. But tonight I'm going to be drinking some fine bubbly.
There you go. All right, Gary, how about you?
What am I doing on New Year's? I'm going to put the kids to bed and probably do what I do every night. And I assume that my wife will be asleep on the couch by 10:30. So. I'll probably have some champagne at midnight and see if I can't do dry January.
Ah, there you go. See, what Gary actually means when he says he's going to do what he does every night is that he's always researching more microcaps from I think 10:30 on till like 2. I'll get the random text of like, yeah, no, title good to go. So he's gonna be researching tonight. I think we can make a safe bet on that.
I read K's, Q's, Form 10s, and whatever else may come the way, and then a whole bunch of other rando nonsense. So
I think he's not going to be doing micro caps. I think he's going to be doing micro beers.
Yeah, micro beers. There we go.
Yeah, there's a good shot at that.
There we go. All right, Steven might have the most. He's in Miami right now. So what are you
I
up
was
to?
going to lead over to proxy statements and things like that. I think now's the time to go through. Gary will write up some reports on the recent Qs and 8Ks and things like that. But no, I'm enjoying myself down here. Just got here, so happy New Year to everyone. Looking forward to starting off next year and with a clean slate. And I just want to thank Bobby for everything we've done this year with SNN Network and his growth and getting to know Kevin and Gary and everyone else who's participated. We appreciate that. And I've had a lot of fun doing that. It's been enriching. There are some positives that have come out of COVID, as we've seen here, and I'm really looking forward to continuing to grow the network in 2021 and continued success for everyone on here, especially you, Bobby. So thank you very much. And I can be found at Steven_Kiel on Twitter.
Thank you, Steven. Thank you, Steven. I really do appreciate that. Thank you. And thank you all to everybody who's watched, one episode or every episode of TIR, the Investors Roundtable. I'm trying to push the acronym. So if you want to call it TIR, that's good too. But really, truly, thank you. Happy New Year. Please be safe. Let's get through this. Let's get these vaccines when they're available. And, I want to do a few of these live in 2021. All right. That's the goal. All right, do a couple TIRs live. So with that, thank you. Happy New Year. Follow me on Twitter at Bobby K. Craft, BOBBYKKRAFT. You can see every episode of the Investors Roundtable on the YouTube channel, youtube.com/SNNWire. I wanted to do that plug quick. All right. So thank you. Happy New Year. See you in 2021.
Happy New Year.